You worked for 40 years. Every paycheck, Social Security came out before you ever saw the money. And when that first benefit check finally showed up, whether it was at 62, 63, 64, there was probably a moment of real relief. Like something you were owed had finally arrived. That feeling makes sense. Because it was yours. You earned it. But here is what most people don't realize until it's too late. That check is not a locked box. It's a system with rules running in the background. Rules that can quietly freeze your payments, trim your monthly amount, or hand a portion of it right back to the IRS, all without anyone calling you to warn you first. You don't have to do anything obviously wrong for this to happen. You just have to not know. A part-time job you took to stay busy. A remarriage you've been putting off out of fear. A municipal bond account you thought was tax-free. Any of these, under the right circumstances, can trigger a rule you didn't know existed and cost you thousands. I'm not saying this to scare you. I'm saying it because the gap between people who come out ahead on Social Security and people who leave money on the table usually isn't income, or age, or luck. It's whether or not they ever looked at the back of the paper. Today we're going to go through the rules they hope you never learn, including Rule 6, which alone can protect tens of thousands of dollars for people in one very specific situation that almost no one talks about clearly. Let's get into it. Let's start with the one that makes people the angriest, and also the one where most of the anger is pointed in the wrong direction. You may have heard something like, the government can tax 85% of your Social Security. And if you heard that for the first time, your reaction was probably something close to fury. You already paid into this system your whole working life. Now they want to tax it again? I get that. Honestly, the first time I had to sit down and actually work through the provisional income formula, I wanted to throw the whole thing out the window. It is unnecessarily complicated for what it actually does. But once you understand the mechanism, you realize two things. It's not as bad as it sounds, and it's also very easy to accidentally make it worse. So let's clear this up. The government is not taking 85% of your check. What the rule says is that up to 85% of your Social Security benefit can be counted as taxable income, meaning it gets added to the pile that the IRS calculates your tax rate on. Whether you actually owe anything on it, and how much, depends on your total income picture and your tax bracket. For a lot of people in a reasonable income range, the real hit is much smaller than that 85% number suggests. But here's where people get blindsided. The IRS uses something called provisional income to decide how much of your Social Security gets pulled into that taxable pile. The formula is 50% of your Social Security benefit plus your adjusted gross income plus any tax-exempt interest you earned. Things like interest from municipal bonds. That last part catches people off guard. You bought municipal bonds specifically because the interest was tax-free, and it is for most purposes. But the IRS still counts it when calculating your provisional income threshold. So you can have an account you genuinely believe is sheltered, and it's quietly pushing you over the line. For a married couple filing jointly in 2026, once your provisional income crosses $44,000, up to 85% of your Social Security becomes taxable. That's the ceiling. Below $32,000, none of it is taxable. Between those two numbers, you're in a sliding zone. Here's why this matters in practice. Say you and your spouse have $28,000 in annual Social Security between you. You also have a modest IRA you're drawing from, plus a municipal bond account that throws off $6,000 a year in interest. You might assume you're fine. But add those numbers up using the provisional income formula, And you may have just crossed the threshold, not because you're wealthy, but because of how the formula is structured. The move isn't to panic. The move is to run the numbers before you make a withdrawal decision, not after. Because once you've taken the money out of a traditional IRA, you can't put it back. That income is already counted. If you had known, you might have pulled from a Roth account instead, or structured the withdrawal differently. The result would have been the same money in your pocket, but with a lower tax exposure on your Social Security. That's the real cost of not knowing this rule. It's not that the government is punishing you. It's that you handed them a lever you didn't know existed. If you've ever looked at your tax return and felt confused about why more of your Social Security seemed to be taxed than you expected, that formula is usually why. Subscribe if you want to keep getting this kind of breakdown, because the next rule is one that cost a lot of people real money for a reason that has almost nothing to do with finances. Before we talk about the rule, I want to talk about what actually happens in the first 6 months of retirement. Because without that context, this rule looks like a simple financial mistake. It's not. You spend decades structured around a schedule, a commute, meetings, a break room where someone always has bad coffee, but you go anyway because it gets you out of your chair. And then one day, that's all gone. The first few weeks feel like a vacation. By month 3, the house is very quiet. I remember a client telling me once that the smell of coffee and the noise of the checkout area at Home Depot made him feel like he was still part of something, that his house couldn't give him that. It wasn't a job. It was a reason to leave the driveway. That's not a financial problem. That's a human one. And it's more common in early retirement than anyone talks about openly. Here's where it becomes a financial problem. If you claim Social Security early, at 62, you already took a permanent reduction. Compared to waiting until your full retirement age of 67, claiming at 62 locks in a benefit that's roughly 30% lower for the rest of your life. That's the trade-off you made, and it can make sense depending on your situation. But if you claimed early and then go back to work, even part-time, even just a few days a week, you run into what's called the earnings limit. In 2026, that limit is $24,480 per year. For every $2 you earn above that threshold, SSA withholds $1 from your benefit. Not a fine, not a penalty letter. They just quietly stop sending you the full check. Take someone like Mark, 63 years old, had enough saved, retired because he was done with the office. 6 months in, the silence got to him. He started driving for a rideshare company 4 days a week. Not for the money, genuinely just to have somewhere to be and someone to talk to. He wasn't thinking about the earnings limit. He wasn't tracking his annual income against a threshold. He was just trying not to feel invisible. Then the letter came. Now, and this is important, the money SSA withholds is not gone forever. That's one of the most misunderstood parts of this rule. When you reach your full retirement age of 67, SA recalculates your benefit and credits you back for the months they withheld payments. Your monthly check goes up to reflect that. So in a long enough time horizon, you do recover it. But that doesn't help you in the months when the check stops. If your budget was built around that income, even partially, a gap like that creates real stress. And for a lot of people, it arrives as a complete surprise. The deeper issue here is one that nobody in personal finance wants to say out loud. Retirement loneliness is driving financial decisions that people don't realize they're making. The part-time job isn't a financial strategy. It's a coping mechanism. And when that coping mechanism accidentally triggers a government withholding rule, the cost isn't just the dollars. It's the feeling that the system caught you doing something wrong when you were just trying to feel okay. The fix isn't to tell people not to work. The fix is to separate the two needs clearly before you make the decision. If you need income, there are ways to structure part-time work that stays under the threshold. If you need connection, there are ways to get that without earned income. Volunteer roles, part-time consulting, billed differently, community programs. The goal is to meet the real need without accidentally triggering a rule that was never designed with your situation in mind. And if you do go over the limit in a given year, run the math before you assume the worst, because the withholding is temporary. The benefit comes back. What matters is whether your cash flow can handle the gap while you wait. This rule is painful specifically because it punishes people for being human, for getting lonely, for wanting to stay useful. That's not a character flaw. That's just what happens when you remove someone's entire daily structure overnight and expect them to be fine. The earnings limit doesn't care about any of that, so you have to. And speaking of things that don't care, there's a piece of advice circulating in financial circles right now about remarriage and Social Security that is causing real harm. Not because it's invented, because it's half true. And a half-truth in this context can cost you your entire survivor benefit. Let me tell you about a kind of loneliness that's different from the retirement kind. Sarah is 64. She lost her husband 6 years ago when she was 58. After a while, longer than people expect these things to take, she started going to a local dance club on Thursday nights, not looking for anything, just trying to remember what it felt like to be somewhere on purpose. She met someone, and over time it became real. But when the conversation about marriage came up, Sarah shut it down, not because she didn't want it. Because she'd read enough, heard enough from friends, seen enough headlines to believe that remarrying would cost her the $2,400 a month she was receiving as a survivor benefit from her late husband. That money was part of how she lived. She wasn't willing to give it up. So they didn't get married. They lived together, shared meals, took trips. But on paper, they were roommates. No legal next of kin rights. No shared medical decision-making. No inheritance protections. She gave all of that up to protect a benefit she didn't actually have to choose between. I have to be honest about something here. There was a time when I would have given the same general warning she'd already heard. Remarriage affects survivor benefits. That's not wrong, exactly. But it's dangerously incomplete, and I didn't fully understand how incomplete it was until I sat down with the actual SSA rulebook and found the exception buried inside it. Here is what the rule actually says. If you remarry before age 60, yes, you lose your survivor benefit from your deceased spouse. That part of the warning is accurate. But if you remarry at age 60 or older, you keep it. All of it. 100% of the survivor benefit continues, regardless of the new marriage. And if your new spouse's benefit would be higher than your survivor benefit, you can switch to that one instead. You get to choose whichever is larger. That's the age 60 exception. It's written into SSA policy. It's not a gray area or a workaround. It's the rule. Sarah was 64 when she met this person. She was 4 years past the threshold. She could have gotten married on any day she wanted and kept every dollar of her survivor benefit intact. Instead, she spent years in a relationship that couldn't protect her legally because she was operating on half the information. That's not her fault. That's a failure of how this information gets communicated, or doesn't. The standard financial advice around remarriage and Social Security tends to collapse the whole picture into one sentence. Be careful, you might lose your benefits. That sentence is true in one specific scenario. It is completely false in another. And when you're 62 or 64 or 66, and you're trying to figure out whether you're allowed to be happy again, you deserve the full picture. Here's what the full picture looks like for someone in Sarah's position. She remarries at 64. Her survivor benefit from her late husband is $2,400 per month. Her new husband's retirement benefit, when he claims, will be $1,900 per month, lower than hers. Under the age 60 exception, she keeps her $2,400 survivor benefit unchanged. She also gains full legal standing as his spouse, hospital visitation rights, the ability to make medical decisions if he can't, inheritance rights, all of it. She didn't have to choose between love and money. The rule never required that of her. She just didn't know. The cost of not knowing this isn't just financial. It's the legal vulnerability of a relationship that exists emotionally but has no protection on paper. If something happens to her partner and they were never married, she has no automatic rights. In some states, she'd be treated as a legal stranger in a medical emergency involving someone she'd been with for years. This is what happens when people make life decisions based on a half-heard rule. The age 60 exception doesn't get mentioned in most of the content out there because it doesn't fit neatly into a headline. Remarriage destroys your benefits is shareable. Remarriage destroys your benefits unless you're over 60, in which case you're completely fine, is a longer sentence that most people don't bother finishing. If you know someone who is widowed or divorced and has been putting off a relationship or a marriage because of this fear, share this with them. The rule they're afraid of may not apply to them at all. Now, survivor benefits are one place the government has actually built in some protection. But there are other places where the government's reach into your Social Security is much less forgiving, including one that's driving a lot of anger online right now, based almost entirely on misinformation. There's a version of Social Security that a lot of people believe in, where once the money is in your account, it's yours and nobody can touch it. That belief is mostly true, but mostly is doing a lot of work in that sentence. Let's talk about the exceptions because they're real, and ignoring them is more expensive than knowing them. First, the IRS. If you owe back federal taxes, the IRS can garnish your Social Security benefit, not your bank account, the benefit itself before it arrives. The maximum they can take is 15% of your monthly payment. That's the federal cap for tax debt. It doesn't require a court order. The Treasury Department can authorize it directly through a program called the Federal Payment Levy Program. If you have unresolved federal tax debt and you're about to start claiming Social Security, this is not something to find out about after the fact. Beyond the IRS, there are a few other situations where your benefit can be reached. Unpaid federal student loans, not private ones. Federal can trigger garnishment. Court-ordered alimony and child support payments can as well. And if you owe money to a federal agency, that debt has a path to your benefit that most people don't know exists. State debts and commercial creditors are a different story. In most cases, they cannot touch your Social Security directly. Credit card debt, medical bills, personal loans, those generally cannot garnish your benefit. That protection is real and worth knowing. But it does not extend to the federal government. The practical point here is simple. If you have any unresolved federal tax liability, address it before you retire, or at minimum, understand what the exposure looks like. Because 15% of a fixed monthly income hits differently than 15% of a paycheck you're still earning. Now let's talk about the other thing, generating a lot of heat online. You've probably seen the comments, the posts, the outrage about non-citizens, undocumented immigrants, foreign nationals collecting Social Security while real Americans get less. I'm going to tell you what the rules actually say, because the conversation around this has drifted very far from the facts. To receive Social Security retirement benefits, a non-citizen must have worked and paid into the system for at least 40 credits. That's 10 years of covered employment, and must be a lawful permanent resident or meet specific visa and residency requirements. There is no shortcut around the credit requirement. The math doesn't bend for citizenship status. Undocumented immigrants are not eligible for Social Security retirement benefits. That is SSA policy. What does happen is that some undocumented workers pay into the system through payroll taxes using individual taxpayer identification numbers, and they will never collect on those contributions. The money goes in. It does not come back out to them. There are also totalization agreements between the U.S. and roughly 30 other countries. These agreements allow workers who split their careers between two countries to combine their credits so they're not penalized for working internationally. It is a reciprocal arrangement. American workers abroad benefit from the same agreements. As for living outside the U.S. after retirement, if you spend more than 6 consecutive months outside the country, your payments can be suspended, depending on your citizenship status and which country you're in. There are exceptions, but the default rule applies. Here's why this matters beyond the facts themselves. The time you spend being angry at a problem that doesn't exist the way you think it does is time you're not spending protecting yourself from the problems that do. The IRS garnishment rule is real. The provisional income threshold is real. The earnings limit is real. Those are the things that will actually affect your check. Misinformation is expensive. Not because it's morally wrong, though it is, but because it redirects attention. Every hour spent forwarding outrage about a false version of the system is an hour not spent understanding the real one. Know what can actually reach your benefit. Ignore the rest. Social Security is not a savings account. It never was. It's a system with real protections built into it and real mechanisms that can quietly work against you if you don't know they're there. The provisional income formula, the earnings limit, the garnishment rules, the remarriage exception that almost nobody explains fully. These aren't obscure technicalities buried in fine print for lawyers. They're the actual rules that determine how much money lands in your account every month for the rest of your life. The people who come out ahead aren't necessarily the ones who planned earlier or earned more or had a better financial advisor. A lot of them just knew where the edges were. They knew that $24,480 was the line. They knew that 60 was the age that changed everything for a widow. They knew to run their provisional income before pulling from a traditional IRA. Not because they're smarter, because they looked it up before the decision, not after. That's the only difference most of the time. What I've watched over the years is that the anxiety around retirement income rarely comes from the numbers themselves. It comes from the feeling that the system is too complicated to understand, that there are rules you don't know about, that something you can't see is going to cost you. And that feeling is hard to shake when you're living on a fixed income and every dollar has a job to do. The answer to that anxiety isn't to avoid the complexity. It's to walk through it once, clearly, so it stops feeling like a threat and starts feeling like a map. You earn this, 40 years of it. The least you can do for yourself now is understand the rules of the system that holds it. If you want to keep building that map, rule by rule, without the noise, hit subscribe for Wes Investor. That's what we do here. See you in the next one.